In the investing world, there are two types of people: those who protect their wealth before stock market crashes, and those who wish they had. Well, today we're exploring why the warning signs of another major downturn are flashing red, while most investors remain dangerously complacent. Hey, Terry, is a crash imminent? I mean, the markets really have been relatively calm of late.
Yeah, Patrice, if you can tell me that, I can show you how to make a lot of money. So timing markets is very difficult. And if you miss the few biggest trading days of the year, you're going to miss out on most of your returns. So we're not in the business of timing markets. I don't think that's a good strategy for most, unless maybe you're the top 0.1% of investors. And unfortunately, I'm not that smart. And I've never met that person, quite frankly. So why do we think you got to be careful now? And that's because the warning signs that are flashing is we're in one of the most extended bull markets of your lifetime. And we know what happened the last time that occurred. That was the 90s. And that ended with the tech crash, which was one of the single biggest crashes we've seen in our lifetime, especially if you were too focused on tech. It crashed 79%. So the overall markets were down 50, which was bad enough. But we know we are closer to the top of the market, or at least we have a strong conviction we're closer to the top of the market than the bottom. And unfortunately, we will get a massive amount of referrals after the market crashes because people will regret that they didn't take action before the market crashes. But the time to act is now, before a market crash, because you can turn a very kind of terrible economic event, meaning a market crash that is affecting everybody very negatively. If you do it right, you can turn this into one of the biggest opportunities for your portfolio, because if you protect and you get to buy the dip, that's the entire game of investing. So I don't see an imminent crash. I see warning signs all over. I don't see that the AI is at the point that the boom of the 90s was. I mean, I think it's still in earlier stages, so I think it has a lot of room to run. That doesn't mean you're not going to see some painful pullbacks along the way. But overall, I do think that this market is due for a recession. And if the Fed if it ever stops putting in this, what we call the Fed put, and stopping these down markets, it's going to happen. It's not if, it's when. So having protection on your portfolio is a big deal.
Walk us through what happened in 2001, and don't forget 2008 when we had the financial crisis, because I think, as you were mentioning percentages there, but people may have forgotten the numbers.
Well, and you get FOMO, fear of missing out. And the problem is everybody's talking about today, it's AI profits. So we have three mega trends. You got AI, you've got robotics, and then you've got how is blockchain integrating into the existing internet. And these things are driving the market. If you take those out, markets are already kind of showing a lot of warning signs. So think back to the .com era. Everybody really did have a fear of missing out. Everybody's making so much money. You got to be a part of this. And when this excitement reaches a roar, that's usually right before a crash. So that was the .com era. Now, that was more of a definitely over exuberance. This thing can run forever, and it just wasn't a reality. There are stocks such as Cisco that dropped, I think it was 60, 70, 80%. They still haven't recovered today, well over 20 years later. So you've got to have defense in your portfolio. Now, take 2008. This was a financial crisis, but this was you have a traditional overexpansion and then crashes. It's just the way a capitalistic economy, which we are, it's how it works. It's normal. It's not to be feared. It's to be expected. But instead of putting your stock market investments in the markets and hoping that the roller coaster ride ultimately goes up, if you put defense in your portfolio, you can take uncertainty to some degree out of your portfolio. And in the long run, we believe, and the numbers ferreted out, that you can actually overperform just a buy and hold Vanguard type performance anyway. So this is expected. A market downturn is going to happen. Don't be fearful. Just be prepared. But I can't tell you how many 60-40 stock bond portfolios we review. And The only defense they have is diversification. And that's not defense. The entire market falls when the market falls. That just protects you from a Madoff or an Enron type scenario where you're in bed with a crook, or you've got one stock, which you can make tremendous wealth with one stock, but you can also lose it very quickly. So diversification is for that. It's not to protect your market in a down market. You're going to get crushed with everybody else.
So what are the early signs you're seeing, the early warning signs?
The market has been going virtually straight up, other than a COVID crash that went right back up, since 2008. We're in 2025 right now. Now, typically, you're going to have 2 recessions during that time frame. We haven't even had one real recession. Now, you can argue over, did the COVID crash qualify as a recession? That was a blip. That wasn't that was fear and then quick recovery because we had the Fed put. So we don't really count that as a recession. So we are significantly overdue for a pullback. And if you poll what the expected returns are for the next decade from most of the top brokerage firms in the country, you'll see that a lot of them, the vast majority, are in that 5.5% or lower is what they think you'll average in the stock market. They don't think you're going to make 5.5%. They think a crash is coming, and then it's going to take you so long to get back to break even and then make some money that maybe you make 5.5% over the next decade. If that indeed does happen and you have some defense in place, you have the opportunity to buy the dip. So we're going to do an upcoming episode that's just all about dry powder. This gives you the effect of dry powder. And more importantly, in a stock portfolio, we all embrace what's called dollar cost averaging, which dollar cost averaging, you're putting, 1,000, 2,000, 5,000 a month away. You're automatically buying more shares of stocks when they're on sale, and you're buying less when they're expensive. But for some reason, people build wealth, and now they have $1 million, $2 million, $3 million, $5 million of wealth, and there's no dollar cost averaging in their portfolio. There's no defense. And it's the industry's fault because they don't teach defense. It's easier to have electronically traded things that people can put you into and go ahead to the golf course. But put a little bit of work into your portfolio, add the defense, and we can bring dollar cost averaging right back into your portfolio. And you can take a period like, I think it was roughly 2009 through 2013, take out your roughly 1% dividends in the S&P 500 and you made roughly zero. If you were dollar cost averaging or doing the strategies that we are talking about, you had roughly a 5.5% compounded rate of return. Not exciting, but a heck of a lot better than zero over 13 years. You're 75% up from a portfolio without defense. So it's not a small deal. We don't recommend anybody manages all their money naked in the market, even if you're 25 years old. Defense wins championships. And I laugh about that because I had a client earlier this week that I'm talking about that, and his wife's kind of smiling. And I'm like, what am I missing? And she's like, he coaches the local high school basketball team. He was a coach. So needless to say, there became a client. He completely got it. But the defense is important. I think right now is the time to do it because I don't know if a crash is imminent or if it's going to be 6 months or a year or 3 years, but we do know it's coming. It's normal cycles of the market.
All right. Now, you advocate for something called defined outcome investing. Please explain, and then what makes this better?
Okay, so defined outcome investing is really what we have kind of branded defense. So when we're doing stocks, so this applies to your fixed income investing also, but we're talking about stocks today. So let me talk about how defined outcome investing can be employed in a stock portfolio. So the way we manage money is we will have some in a category we call naked in the market. Now, naked in the market is what most people do with their entire stock allocation. It's just in the stock market, whether you're growth-based, index-based, value-based oriented, concentrated positions, it's naked in the market. So these are actual stock investments. And we do that for a portion of the stock because you will have periods of 10, 15 years that are straight up and you want some on the roller coaster ride. That part of the stock allocation, I would say, is not defined outcome. You're holding on and hoping that it does well, and history is in our favor. So it is a part of the portfolio. The two parts that are more defined outcome, we embrace two primary strategies. The first one is a cap strategy. Now, this is something that trades daily, great liquidity, but you're going to give up some of the upside in order to achieve some downside. So for instance, I own a position that is a 16% cap on the S&P 500. So that means in the year that I'm holding this, I will get the first 16% of the upside. But if the market crashes, I will get the first 5% of losses, but then the next 30%, I don't lose anything. So your average recessionary markets are down in excess of 30%. Now, 2008, it was down 55%. 2001, that recession was down 50% for the overall markets. So if you lose beyond 35%, you start losing again. So in a cap, we're basically protecting you from 30% of the downside. You get the first 5, the next 30, you don't lose anything. If it goes beyond that, you still have stock market exposure, but you're doing a heck of a lot better than your neighbors that were naked in the market at that point, which allows you to buy the dip. Now that's a cap strategy, and there's all varieties. So if you're doing it on the NASDAQ, you might have one set of parameters or defined outcomes. If you do it on the S&P, you'll have another set. If you do it on a global developed or emerging markets, it'll be another set of parameters. But that category is something that should be a part of every portfolio, in our opinion. Then you have target strategies. Now, a target strategy, one of our kind of baseline ones that most people have exposure to, we're targeting 80% of the upside of the market, like the S&P 500 as an example. But in a down market, the goal is to break even plus or minus 1 to 2%. Now, if you can do that over a 20-year investment cycle, the vast majority of the 20-year cycles in your entire lifetime, you would have done better than the vanguards of the world, and in most periods by a long shot. So the target strategy is very powerful, and you take a fraction of the risk of just investing straight into the market. Now, which of these three are better? So if you look at most periods, target is the winner. Naked is second, but it's really third. And capped is last. But the actual winner and the approach that we take is all three. And then you do two things. We want to bring dollar cost averaging into your portfolio. So we try to have money maturing every single month, because I don't know about the listeners out there, but I'm not good enough to time when the next crash is going to be exactly. So I want money coming due. So if we have a COVID crash and I break even and I get to buy this dip, then all of a sudden I'm up 25%, 90 days later, we want the system to do that. Because as a colleague of mine says, which Patrice, you know him very well, systems work, people fail. It's like,
this is true.
So the key here is this system brings dollar cost averaging into portfolios, and our clients typically have 1 to 10 million in their retirement accounts and their portfolios. So it's very important to bring dollar cost averaging back. So if we have money coming due regularly, we get to buy the dips. Now, the second thing we want to do is rebalance periodically. So if the stock market, let's say naked in the market, is going straight up like right now, it should be the biggest of those three categories. You need to trim off some of those profits and protect them. And then if the market is crashed, target is going to be the number one strategy probably. So what you're going to want to do there is trim some off the target strategies and put it in naked in the market, because when the markets drop 30% or more, historically, that's a phenomenal time to buy. But it's a phenomenal time to buy, but it's also, it always feels like this time it's different. The market's going to keep going down. So a lot of times people will use a different form of a target that we offer that we can get from 80 to 140% of the upside, but we can't break even in those markets. Over a 2-year period, our target is to lose no more than 10%. But if we're down 30, 40% and you want to get 140% of the upside, knowing that, yeah, I can lose another 10, but I can also be part of this rebounds, which are often violent. Imagine getting 140% of a rebound. That could be phenomenal. So these are things that we build, we don't buy. So they're very much a target, and you got to make sure they're built well. But that's what we go over, teach our clients, and we implement all three of those strategies. And that's what I call the core or cornerstones to a stock portfolio. And everybody should have a different mix maybe, but they should have a variation of all three of those. And we call that defined outcome collectively.
Do fixed income annuities have a role here?
Yeah, so fixed indexed annuities are often sold as a stock alternative. And partly it's because if you look at how some of these indexes, especially by a company called the Nexus that we work with, that has really good financial engineering that they then work with insurance companies and their other partners in order to put them within a fixed index annuity. So they're not your mom or grandmother's annuity. They have the potential to do far better. These indexes can sometimes give you stock market like performance with complete downside protection. Now they do that. Like there's 10-year periods where you average 14.5% in one of the products that we like. And that's phenomenal. That beats the stock market during that same period. But it doesn't matter what it could have done based on today's crediting rates with what happened over the last 10 or 20 years. It matters what today's crediting rates can get us the next 10 years. And that's a mistake that is often made because unscrupulous insurance people will be out there promoting it as if somebody got these returns. And they didn't. These crediting rates didn't exist 10 years ago. We're at a period of time where crediting rates for indexes and fixed index annuities are phenomenal. So I think they have a very definite spot in a portfolio. In our firm, we place it more as a bond alternative, part of your fixed income bucket, so to speak. So it's part of 60-40 stock bond portfolio. Bonds are a type of fixed income. We use multiple strategies there. Fixed index annuities are one of them. So yes, they can give you stock market performance or stock market type performance at times, but we would say that that's your bond allocation overperforming. And we absolutely hope it does. But we typically don't count it as part of the stock market performance, but other advisors do. So you will see that out there. And those aren't as liquid. So the strategies we're talking about are quarterly liquidity to daily liquidity. The strategies where you talk about a fixed index annuity, you might have 7 to 10% liquidity each year, but you'll pay penalties if you take out more than that. They're still great in the right proportion. But again, we would consider it a bond alternative, fixed income alternative, not an actual stock alternative.
Is there any way that, your average Joe investor can implement these strategies in his or her portfolio?
Absolutely. I mean, I don't know if you call our clients average Joes because they typically have 1 to 10 million of retirement monies. But anybody can do that. The minimums are minor. So it's something that, I have other advisors in our firm that do the same exact system in portfolios as myself, but they work on smaller portfolios. They get all the same benefits. They're just working with another advisor. Like I've got 35 years experience. I might be somebody that has 10 years experience. But yes, everybody can do this. There are some strategies that you have to be what's called accredited, meaning you have to have $1 million of net worth outside of your home or make more than $300,000 as a couple. But most of the strategies, there's a version, if not the mainstay version. You can do it if you're non-accredited and if you're 25 years and putting $1,000 a month away. So it is not an exclusive club. Anybody can embrace defined outcome investing, and everybody should, in my opinion.
Yeah, definitely. Now, for folks who are listening and they want to make this transition to defined outcome investing, what's the first step?
Well, I would say the first step is don't wait. We are at a point in the market right now that we're closer to the high than the low. So get the protection in place as soon as you can. But the steps are, if you're working with our firm, of course, we bring you in and we have a process, and you can reach us just by calling Chris, who's our client services coordinator. She's at 916-325-0130, and she'll set you up an initial meeting. Or you can go to our website. So it's www.weariaadvisors.com, and you can reach us there. So whatever is best for you, we are here to help if we can be of help to you. Or if you just have a question that you want to run by or want a second opinion on your portfolio, we're happy to do that. Or if you're working with another advisor that is doing this type of planning, then you're in good hands. You don't need to switch to us, but that is very few advisors that we run across are doing this. They'll throw a fixed index annuity and call it downside protection. And yes, it is downside protection, but it just should not be 60, 70, 80% of your portfolio. It should be have a position in your portfolio, but these defined outcome strategies give you stock market performance, but they give you great liquidity, and we need a healthy combination of both.
Well, Terry has outlined it, my friends. Don't just brace for the next crash. You can prepare for this. Put in a good defense with defined outcome investing, and you can prepare to thrive in the next down market. Of course, follow this podcast too for all the great information that comes from it, the insights that Terry has. Share with others. I'm Patrice Sikora, and thanks for being with us.
Yes, thank you, Patrice. Have a wonderful day.
Thank you for listening to We Money Talk with Terry Wheeler. Be sure to click the follow button to be notified as new episodes become available. Information presented is for educational purposes only. No listener should assume that any discussions or information presented serves as the receipt of or substitute for personalized advice from We Alliance Wealth Advisors, Inc. or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. We Alliance Wealth Advisors, Inc. is not a law firm or accounting firm, and no portion of this podcast should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not appropriate for every individual. Listeners are encouraged to seek advice from qualified tax, legal, or investment advisors to determine whether any information presented may be suitable for their specific situation.